Welcome, welcome, welcome. This is the Fundability Report, and today's topic, the news of that's all over the news, is what's going on with the precursors. Is there a banking crisis going on? Is there something we need to worry about, et cetera, et cetera? So we're going to talk about news you hear everywhere else, but we're going to talk about fundability and how it's going to impact you. First of all, one of our fundamental fundability strategies is to use the top tier banks for our personal and or business checking, saving, etc. Right? And so when it comes to Signature Bank, one of the banks that have failed, and the Silicon Valley Bank, Signature is a low tier 2. Top 40 banks, it's a low tier 2, and Silicon Valley is actually tier 3. It is not even a tier 2 bank. So let's do just a roundabout of how the banking works and why has this been a problem. First of all, banks currently in our current central bank model, banks lend. I lend money. Banks lend money to the tune of 10x what's in their reserves. Now, reserves do not include borrowers' deposits. Reserves are what happens when a bank makes money, profits, and whatever they decide as a board, they will literally decide we're going to give shareholders X amount of dollars, and we're going to put the rest in reserves. Think of it as a savings account, right? When they put it in reserves, they can then lend 10x of whatever's in the reserves. So if there's $1 billion in the reserves, they can lend $10 billion. That is not depositors' money, right? So the FDIC, the Federal Deposit Insurance Corporation, guarantees up to $250,000. That was raised in 2008, but now the FDIC has now decided that it's going to guarantee all deposits, regardless of the amount, including above $250,000, to calm the waves, right? Calm the panic that some people are feeling. Now, what's happened is that because they call it liquidity. Liquidity is how much you have in reserves, right? And so if banks have a hard profit quarter and their reserves lower, there's less money that is supposed to be extended. So that's when you may have seen it in 2008, they'll lower limits on revolving accounts. They may call loans due on some businesses or personal loans, trying to pull back to match how much money they have in reserve. 10x is all that can be out or extended of what they have in reserve. So if this is the case, then what is happening is that the bank, Signature and Silicon Valley, and you'll hear all the details. I'm talking super high level, 1,000-foot view. They're overextended in some fashion. Their loans could have been called due or otherwise, but when depositors hear that a bank is failing, they think that their money is at risk. And so that money that is on deposit, they make a run for that. Well, since a bank does not have all of the cash in their vault to pay it off, these are all book notes, right? On their books, the 10x and everything else. If you have $10,000 on account, there's not $10,000 in cash there. So they have to go get loans from some of them are running on the FDIC. They're getting overnight loans, or they're getting short-term loans from the FDIC or from the Fed. There's a number of places they can go to get the actual dollars to pay the depositors. This is separate than the liquidity that they have in case A and case B. It's separate than the liquidity they have out in loans. The liquidity they're talking about in this case is how many dollars do they have to give to somebody. Now, most people aren't pulling cash out. Some of them are transferring it. Now, here's what's fascinating. In this particular case, all the small banks where people might be going to get their money, where do you think they're taking that money? To the big banks, the very banks that we teach have the most amount of staying power. They were too big to fail in 2008. And those big banks are the ones collecting the deposits, the transfers through Zelle, through bill pay, through cash, whatever it is. So there's two forms of liquidity that we've talked about. The liquidity they're saying that's in the vault, if there's 10,000 cash on hand and $100,000 worth of depositors come to collect their money, they got to go borrow $90,000 to cover those. That's where we get into trouble, because banks, now here's where it gets fuzzy. Roll with me. Banks, everybody has to be accountable for every penny. Human beings, we think that the actual dollar that we pull out is the most trustworthy form of money, right? We can call it fiat currency. We can call it gold back in the day. But if it's in my hand, it's trustworthy, is what everybody believes. Having dollars on a ledger, 10,000 or 10 million on a ledger, to some are not trustworthy. And so people, a run on the bank is where they lack faith that the zeros on their ledgers are just as trustworthy as the cash in their hand. And so people get scared. They run out. They get the dollar things they can hold in their hands. And now there's not that much cash in any of the banks. Seriously, there's not that much cash in any of the banks because everybody uses ledger entries to treat and take care of and be accountable for every penny. So what happens is, and I don't even have a good metaphor. I'm known for my metaphors and analogies. I don't even have one. But it's like they're going and getting something that doesn't exist in the real banking world. We run everything by ledger. But because I'm transferring it out of a bank, we call it a run on the bank, and it wreaks havoc because everybody's taking this digital world and trying to move it into the physical world. And we haven't been a physical economy for 20 years when it comes to cash. And so that run on the bank is, we translate the digital into the real world. That's really what's happening. That's where the scare is, that people are trying to move. Even if you're moving it with Zelle, then if you're moving it with Zelle, instead of going and getting cash, now you're still in the digital world, and you can move that, and that doesn't harm the bank because the depositor's money is the depositor's money. It's just that, I don't know, 20 to 1 dollars on the digital books compared to $1 in the vault, the cash currency dollars in the vault. So stop the madness. Stop the madness. There isn't anybody in our government or in the banking system right now. There isn't anybody who doesn't know that we have enough zeros and ones on paper or digital to cover every depositor. The problem is when people want money that doesn't exist in the real world to translate it into the real world, that's where we end up in trouble. So, well, now that's the 1,000-foot view. There are where all the big questions are being asked. Where are regulators going wrong? Where did the system fail? And there are smaller banks that have tapped this week $90 billion in liquidity to prepare for people who want to take out digits and translate it into the real world. No one's going to lose money in this system, you guys. Now, that's a bold statement, but they're already approved going above the FDIC has already approved going above and beyond the $250,000 guarantee. So digits versus paper currency. If you keep it in the digit form, it is the most likely case scenario that you've got your back covered. The problem begins when you try and translate those dollars into paper currency, that there are not enough dollar bills in the United States physically to cover even a small percentage of the money that is in circulation. Doesn't exist. We're digital. So stop. Of course, take care of you, take care of your family, but transfer through Zelle, transfer through bill pay, keep it in the digital universe, and I'm sticking my neck out here, but you'll be fine. This is Merrill Chandler, your host of the Fundability Report, and welcome. If you didn't think we were digital before, now we know that we're digital now. See you next time.